Section 8 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Part 2, Setting the Stage, Chapter 3, Securitization and Derivatives. Fannie Mae and Freddie Mac, the whole army of lobbyists. The crisis in the thrift industry created an opening for Fannie Mae and Freddie Mac, the two massive government-sponsored enterprises, or GSEs, created by Congress to support the mortgage market. Fannie Mae, officially the Federal National Mortgage Association, was chartered by the Reconstruction Finance Corporation during the Great Depression in 1938 to buy mortgages insured by the Federal Housing Administration, or FHA. The new government agency was authorized to purchase mortgages that adhered to the FHA's underwriting standards, thereby virtually guaranteeing the supply of mortgage credit that banks and thrifts could extend to homebuyers. Fannie Mae either held the mortgages in its portfolio or, less often, resold them to thrifts, insurance companies, or other investors. After World War II, Fannie Mae got authority to buy home loans guaranteed by the Veterans Administration, VA, as well. This system worked well, but it had a weakness. Fannie Mae bought mortgages by borrowing. By 1968, Fannie's mortgage portfolio had grown to $7.2 billion, and its debt weighed on the federal government. To get Fannie's debt off of the government's balance sheet, the Johnson administration and Congress reorganized it as a publicly traded corporation and created a new government entity, Ginnie Mae, officially the Government National Mortgage Association, to take over Fannie's subsidized mortgage programs and loan portfolio. Ginnie also began guaranteeing pools of FHA and VA mortgages. The new Fannie still purchased federally insured mortgages, but it was now a hybrid, a government-sponsored enterprise. 2 years later, in 1970, the thrifts persuaded Congress to charter a second GSE, Freddie Mac, officially the Federal Home Loan Mortgage Corporation, to help the thrifts sell their mortgages. The legislation also authorized Fannie and Freddie to buy conventional fixed-rate mortgages, which were not backed by the FHA or the VA. Conventional mortgages were stiff competition to FHA mortgages because borrowers could get them more quickly and with lower fees. Still, the conventional mortgages did have to conform to the GSE's loan size limits and underwriting guidelines, such as debt-to-income and loan-to-value ratios. The GSE purchased only these conforming mortgages. Before 1968, Fannie Mae generally held the mortgages it purchased, profiting from the difference or spread between its cost of funds and the interest paid on these mortgages. The 1968 and 1970 laws gave Ginnie, Fannie, and Freddie another option: securitization. Ginnie was the first to securitize mortgages in 1970. A lender would assemble a pool of mortgages and issue securities backed by the mortgage pool. Those securities would be sold to investors, with Ginnie guaranteeing timely payment of principal and interest. Ginnie charged a fee to issuers for this guarantee. In 1971, Freddie got into the business of buying mortgages, pooling them, and then selling mortgaged-backed securities. Freddie collected fees from lenders for guaranteeing timely payment of principal and interest. In 1981, after a spike in interest rates caused large losses on Fannie's portfolio of mortgages, Fannie followed. During the 1980s and 1990s, the conventional mortgage market expanded. The GSEs grew in importance, and the market share of the FHA and VA declined. Fannie and Freddie had dual missions, both public and private: support the mortgage market and maximize returns for shareholders. They did not originate mortgages, they purchased them from banks, thrifts, and mortgage companies, and either held them in their portfolios or securitized and guaranteed them. Congress granted both enterprises special privileges, such as exemptions from state and local taxes and a $2.25 billion line of credit each from the Treasury. The Federal Reserve provided services, such as electronically clearing payments for GSE debt and securities as if they were Treasury bonds. So Fannie and Freddie could borrow at rates almost as low as the Treasury paid. Federal laws allowed banks, thrifts, and investment funds to invest in GSE securities with relatively favorable capital requirements and without limits. By contrast, laws and regulations strictly limited the amount of loans banks could make to a single borrower and restricted their investments in the debt obligations of other firms. In addition, unlike banks and thrifts, the GSEs were required to hold very little capital to protect against losses, only 0.45% to back their guarantees of mortgage-backed securities, and 2.5% to back the mortgages in their portfolios. This compared to bank and thrift capital requirements of at least 4% of mortgages assets under capital standards. Such privileges led investors and creditors to believe that the government implicitly guaranteed the GSE's mortgage-backed securities and debt, and that GSE securities were therefore almost as safe as Treasury bills. As a result, investors accepted very low returns on GSE guaranteed mortgage-backed securities and GSE debt obligations. Mortgages are long-term assets often funded by short-term borrowings. For example, thrifts generally used customer deposits to fund their mortgages. Fannie bought its mortgage portfolio by borrowing short and medium term. In 1979, when the Fed increased short-term interest rates to quell inflation, Fannie, like the thrifts, found that its cost of funding rose, while income from mortgages did not. By the 1980s, the Department of Housing and Urban Development, HUD, estimated Fannie had a negative net worth of $10 billion. Freddie emerged unscathed because, unlike Fannie then, its primary business was guaranteeing mortgage-backed securities, not holding mortgages in its portfolio. In guaranteeing mortgage-backed securities, Freddie Mac avoided taking the interest rate risk that hit Fannie's portfolio. In 1982, Congress provided tax relief, and HUD relaxed Fannie's capital requirements to help the company avert failure. These efforts were consistent with lawmakers' repeated proclamations that a vibrant market for home mortgages served the best interests of the country. But the moves also reinforced the impression that the government would never abandon Fannie and Freddie. Fannie and Freddie would soon buy and either hold or securitize mortgages worth hundreds of billions, then trillions of dollars. Among the investors were U.S. banks, thrifts, investment funds, and pension funds, as well as central banks and investment funds around the world. Fannie and Freddie had become too big to fail. While the government continued to favor Fannie and Freddie, they toughened regulation of the thrifts following the savings and loan crisis. Thrifts had previously dominated the mortgage business as large holders of mortgages. In the Financial Institutions Reform, Recovery, and Enforcement Act of 1989, FREA, Congress imposed tougher bank-style capital requirements and regulations on thrifts. By contrast, in the Federal Housing Enterprises Financial Safety and Soundness Act of 1992, Congress created a supervisor for the GSEs, the Office of Federal Housing Enterprise Oversight, or OFHEO, without legal powers comparable to those of bank and thrift supervisors in enforcement, capital requirements, funding, and receivership. Cracking down on thrifts, while not on the GSEs, was no accident. The GSEs had shown their immense political power during the drafting of the 1992 law. OFHEO was structurally weak and almost designed to fail, said Armando Falcon Jr., a former director of the agency, to the FCIC. All this added up to a generous federal subsidy. One 2005 study put the value of that subsidy at $122 billion or more, and estimated that more than half of these benefits accrued to shareholders, not to home buyers. Given these circumstances, regulatory arbitrage worked as it always does. The markets shifted to the lowest cost, least regulated havens. After Congress imposed stricter capital requirements on thrifts, it became increasingly profitable for them to securitize with or sell loans to Fannie and Freddie rather than hold on to the loans. The stampede was on. Fannie's and Freddie's debt obligations and outstanding mortgage-backed securities grew from $759 billion in 1990 to $1.4 trillion in 1995 and $2.4 trillion in 2000. The legislation that transformed Fannie in 1968 also authorized HUD to prescribe affordable housing goals for Fannie, to, quote, require that a reasonable portion of the corporation's mortgage purchases be related to the national goal of providing adequate housing for low and moderate income families, but with reasonable economic return to the corporation, unquote. In 1978, HUD tried to implement the law, and after a barrage of criticism from the GSEs and the mortgage and real estate industries, issued a weak regulation encouraging affordable housing. In the 1992 Federal Housing Enterprises Financial Safety and Soundness Act, Congress extended HUD's authority to set affordable housing goals for Fannie and Freddie. Congress also changed the language to say that in the pursuit of affordable housing, quote, a reasonable economic return may be less than the return earned on other activities, unquote. The law required HUD to consider, quote, the need to maintain the sound financial condition of the enterprises, unquote. The Act now ordered HUD to set goals for Fannie and Freddie to buy loans for low and moderate income housing, special affordable housing, and housing in central cities, rural areas, and other underserved areas. Congress instructed HUD to periodically set a goal for each category as a percentage of the GSE's mortgage purchases. In 1995, President Bill Clinton announced an initiative to boost home ownership from 65.1% to 67.5% of families by 2000, and one component raised the affordable housing goals at the GSEs. Between 1993 and 1995, almost 2.8 million households entered the ranks of homeowners, nearly twice as many as in the previous 2 years. Quote, but we have to do a lot better, unquote, Clinton said. Quote, this is the new way home for the American middle class. We have got to raise incomes in this country. We have got to increase security for people who are doing the right thing, and we have got to make people believe that they can have some permanence and stability in their lives, even as they deal with all the changing forces that are out there in this global economy," unquote. The push to expand homeownership continued under President George W. Bush, who, for example, introduced a zero down payment initiative that, under certain circumstances, could remove the 3% down payment rule for first-time home buyers with FHA-insured mortgages. In describing the GSE's affordable housing loans, Andrew Cuomo, Secretary of Housing and Urban Development from 1997 to 2001, and now Governor of New York, told the FCIC, quote, "Affordability means many things. There were moderate income loans. These were teachers. These were firefighters. These were municipal employees. These were people with jobs who paid mortgages. These were not subprime, predatory loans at all," unquote. Fannie and Freddie were now crucial to the housing market, but their dual missions, promoting mortgage lending while maximizing returns to shareholders, were problematic. Former Fannie CEO Daniel Mudd told the FCIC that, quote, "The GSE structure required the companies to maintain a fine balance between financial goals and what we call the mission goals. The root cause of the GSE's troubles lies with their business model," unquote. Former Freddie CEO Richard Siren concurred, quote, "I don't think it's a good business model," unquote. Fannie and Freddie accumulated political clout because they depended on federal subsidies and an implicit government guarantee, and because they had to deal with regulators, affordable housing goals, and capital standards imposed by Congress and HUD. From 1999 to 2008, the two reported spending more than $164 million on lobbying, and their employees and political action committees contributed $15 million to federal election campaigns. The, quote, "Fannie and Freddie political machine resisted any meaningful regulation, using highly improper tactics," unquote. Falcon, who regulated them from 1999 to 2005, testified, quote, "OFHEO was constantly subjected to malicious political attacks and efforts of intimidation," unquote. James Lockhart, the director of OFHEO and its successor, the Federal Housing Finance Agency, from 2006 through 2009, testified that he argued for reform from the moment he became director, and that the companies were, quote, "allowed to be so politically strong that for many years they resisted the very legislation that might have saved them," unquote. Former HUD Secretary Mel Martinez described to the FCIC, quote, "the whole army of lobbyists that continually paraded in a bipartisan fashion through my offices. It's pretty amazing the number of people that were in their employ," unquote. In 1995, that army helped secure new regulations, allowing the GSEs to count toward their affordable housing goals not just their whole loans, but mortgage-related securities issued by other companies, which the GSEs wanted to purchase as investments. Still, Congressional Budget Office Director June O'Neill declared in 1998 that, quote, "the goals are not difficult to achieve, and it is not clear how much they have affected the enterprise's actions. In fact, depository institutions, as well as the Federal Housing Administration, devote a larger proportion of their mortgage lending to targeted borrowers and areas than do the enterprises," unquote. Something else was clear. Fannie and Freddie, with their low borrowing costs and lax capital requirements, were immensely profitable throughout the 1990s. In 2000, Fannie had a return on equity of 26%, Freddie 39%. That year, Fannie and Freddie held or guaranteed more than $2 trillion of mortgages, backed by only $35.7 billion of shareholder equity. End of section 8.